Who's Farhan Khan? Farhan Khan is from St. Joseph's or Garden City? No. See, until now we've learned many topics. We've gone through the basics of accounting, then cost accounting, methods of cost accounting, then a part of the statistical tools which are used in forecasting. We've gone through that. Then learned about planning, budgeting, budgets, variance analysis. Okay, so we've covered so many topics. Now, all this information is important to be provided to the top management so that they can take decisions. Now, after all these things, the next topic what we have is performance measurement. This is called as performance measurement or performance management. What does it mean basically? See, when the planning is implemented, the planning and the implementation part of it, if after it is taken up, whether the implementation is according to the plan or not, is what has to be verified. The performance has to be measured. There are many tools to measure the performance, but the one which is covered under our syllabus. So let's look into this one. The first part of it is about ratio analysis. We'll work out on the what's the meaning of ratio. Ratio is the mathematical expression of two variables. That's called as a ratio. Now, if the performance has to be measured, the performance can be measured by one technique. What is used for us is by way of calculating ratios from the financial statement, and then understand whether any aspect of the organization is good or any other thing, good, bad, or any suggestions can be given. So, variables from the financial statement, that's the income statement, balance sheet, cash flow statement. Variables are taken from the financial statements and they are presented in the form of a ratio. Now, each of these ratios, there are certain things which are taken into consideration for measurement. And by way of calculated ratios, the performance of the organization can be measured or it can be known. There are many items under income statement, there are many items under balance sheet. So any two variables at a time. For a ratio, any two variables are selected, um, they are presented in a mathematical form, in a ratio form, ratio is calculated. After that, we see the based on the value, the interpretation is given. See, there is a classification of ratios. Many See, there is a different way in which the classification is also presented, but nevertheless, everybody talks about the same set of ratios. We see that there are broadly classified. We can present it as the first one talks about liquidity, the second one talks about profitability. Then we see the turnover ratios, activity or turnover ratios, and we'll put this one as long liquidity. This we can present it as solvency ratios because immediately one after the other. And then finally, we have the profitability ratio. In any order, any manner, it can be given. Some of them give it as five types of ratios: liquidity, solvency, turnover ratios, and turnover ratios, profitability ratios, and coverage ratios. So that category is separately mentioned. So whatever is the situation, basically all the ratios indicate about some aspect of the organization. So when the ratios are calculated, they convey some meaning, they convey some message, which is whether the position is good, bad, or average, or very bad, or whatever is that, that is conveyed. So maybe sometimes certain suggestions can be given to improvise the performance. Okay, that can be taken up. So here in our syllabus, we have the performance measurement, the financial aspect of it, financial performance. Here it's given, the first thing which is given is about the profitability ratios. I will explain all of them. Then we have the liquidity ratios. After liquidity ratios, we have the activity or the turnover ratios. Then we have financial performance or the risk ratios. Um, then the divisional performance. So this is one category which is mentioned. Then we have non-financial performance ratios. Okay, there are other aspects of performance measurement. So they are basically non-financial in nature. So there are other ways in which the performance can be measured. So this is all what we have. So let's start with that. In any order, any category, anything what is taken up can be studied. The first one talks about what is the profitability. The profitability ratios can be calculated from the income statement alone, from the balance sheet also they can be calculated. So when we start this, if we are talking about under that, the first ratio is, of course, the PPT does not explain all of them, but we'll just run through all these ratios. The first ratio is gross profit ratio is equal to gross profit by sales into 100. The logic is because the income statement, the main source of revenue is sales. If this is the amount of sales which is made, that is sales is 100%, that is the base. Gross profit is what percentage? Gross profit is what percentage? Similarly, net profit ratio also can be calculated. Net profit is what percentage? Then we have a concept called as operating profit. I hope you know the income statement format. So from the income statement, we also see what is the operating profit. Operating profit is what percentage. Whatever we present it, basically that is compared with the sales. Sales, if the it's taken as 100%, um, what is the percentage of profit? So whether it is gross profit ratio, gross profit by sales into 100. Sometimes it's simply called as, without having a prefix like gross, operating, net, or something. They can just talk about what is profit margin or profit percentage on sales. So it whatever is the profit given, profit divided by sales into 100. Then we have operating profit ratio. Gross profit, net profit, operating profit, all of them are taken from the income statement. then income statement also sometimes it suggests that calculate the cost as a percentage of sales, like cost of goods sold or any other operating expense, any specific expense also. It can be calculated in this manner, that is, they are compared with sales. If sales is 100%, what is the percentage of cost? So what percentage of the total revenue is cost also can be, maybe we can have a better understanding, insight about what is the percentage of cost which is incurred. So that way it can be taken up. Then we see that the variables are taken not only from the income statement, but also we have variables coming out of the balance sheet. Okay. So on that note, they have explained it here, a set of ratios. The first one talks about return on CE is capital employed, return on capital employed. Okay, then this is return on sales, just now what we have discussed. Then we will look into this here only. I will talk about what are the variations which are present here. The first term is return on capital employed. What is capital employed? Capital employed is the total amount of capital which is raised. So capital is raised from owners, we call them as shareholders, and also from outsiders, we call them as debt holders. I hope you all know these things, these terms. Assuming that you know that, if you have any issue with that, then you please raise it and then I'll clarify it. See, when we have the balance sheet which is given, on the liability side, we see that the first item is current liabilities. Then we see the all of them are long-term liabilities. So under the non-current liabilities, that is for a longer period of time. Current liabilities, the time period is 1 year. So under non-current liabilities, the amounts can be raised from debt capital and equity capital. Outsiders, when they invest the amount, we call that as debt capital. Owners, when they invest their amount, we call that as equity capital. Done. After current liabilities and non-current liabilities, and then if these are the sources from which the capital is raised, so we see that net non-current liabilities, which includes debt capital and equity, non-current liabilities plus the total equity. So debt is also referred to as non-current liability or long-term liability. Basically all of them are long-term liabilities only, but the terms which are very much in usage is long-term liability, because that is differentiated with current liabilities. Current is for short period, long-term liability is for a longer period of time. And equity is the owner's contribution, shareholders, and then anything which belongs to shareholders. Okay, that is the total capital. This amount is this plus this, debt plus equity is the total capital. If total capital is 100%, the operating profit which is earned, I hope you know what is the format of income statement. Are you aware of the format of income statement? You must have done in your first semester. I hope I am audible. No response is coming. Are you aware of the format of income statement? Am I audible? At least for that, somebody respond.
Yes, ma'am.
Okay. Thank God. Um, take down the format of income statement. The income statement starts with sales. Then we see less cost of goods sold. I would be writing all short forms. If it's not clear, ask me. Then we have, this is called as gross profit. Then from this we have less operating expenses. The resultant figure is called as operating profit, then we see less non-operating expenses and add non-operating incomes. After that, the resultant figure is called as EBIT, earnings before interest and tax. Most of the time, when they assume that these two things do not exist, that is non-operating um, profits or non-operating expenses or non-operating incomes, assuming that they do not exist, interchangeably we see operating profit and EBIT are used. So most of the time, EBIT is also referred to as operating profit. Now, this is the total amount of profit available to all the investors. Investors are outsiders, debt holders, and the shareholders, which is equity. From EBIT, then we see less interest. Outsiders are given the first preference. So we see that interest is deducted. This is called as EBT, earnings before tax. Then we see less tax. This is called as EAT, earnings after tax. Then we have less dividends, but dividends also first dividends are paid to preference shareholders. So we have the preference dividend, preference dividend deducted. So this becomes the net income available to common equity shareholders. After this, see if equity shareholders are paid some amount, we see equity dividend or common dividend, what we can call it as common equity dividend. And this is called as retained earnings. Please make a note of it and then keep it, keep a copy with you, because every other topic what you learn about financial statements, you will be referring to this one. This is the detailed format of the income statement starting from sales till the retained earnings. So if you have an idea about what items are there and in the sequence in which they are presented, then we can take up what are the ratios. Okay, now come back to return on capital employed. When we talk about return on capital employed, so capital which is raised by all the investors, that is outsiders, debt holders, and the owners, equity holders. So all of them equity shareholders, or the shareholders. So all of them, the amount which of profit which is available is EBIT. This is the amount of profit which is available to all of them. From this EBIT, interest is paid. Of course, tax is an obligation which has to be paid. Interest is paid. Then we have preference dividend. Then we have common dividend. So all the costs which are paid on capital are met out of EBIT. So whether sufficient amount of profit is available in the form of EBIT or not is what has to be assessed here. So return on capital employed, the total capital employed here is the, until now what were you seeing? But did you see the word file till now? Did you see
The
this?
PDF is showing, ma'am.
What?
Now we can see.
Oh my god, you were not seeing this one. Okay. Please make a note of this. I'm telling you from that time. Please make a note of it. Please make a note of. You didn't even tell that you were not able to see the word file. Quickly, let me highlight it. Make a note of this one. We have sales. Sales minus cost of goods sold is called as gross profit. Now from gross profit, the operating expenses are deducted is called as operating profit. Then non-operating expenses are deducted and non-operating incomes are added. So the resultant figure is called as EBIT. Then from EBIT, interest is paid. It's called as EBT. From EBT, tax is paid. It's called as EAT, earnings after tax. Then preference dividend is deducted. Then the resultant figure is called as net income available to common equity shareholders. And then from that equity dividend is deducted. The resultant figure is retained earnings. So we'll come back to word file just a minute. The equation, the ratio what we are discussing here is return on capital employed. So return on capital employed is the total amount of capital employed. If capital employed is 100%, if this is the total amount which is invested, the profit which belongs to them, all of them, all types of capital, debt capital and equity capital. So the profit which is available to them is what percentage? So which profit is available to them? So I'm taking you to word file. Now out of this, okay, which profit is available to them? Capital employed is 100%. So the profit which is available to them is the EBIT. EBIT is the profit which is available to them. Out of EBIT, interest is paid. Okay. Then preference dividend is paid. Then common dividend is also paid. So this is the profit which is available to them. So we take EBIT is what percentage? It didn't strike to anyone that I was writing something when I was talking about so many terms. It didn't strike to you that I was writing somewhere. Great people.
Ma'am, we were noting in our notepad, ma'am.
No, no, no. You should have told me, ma'am. Write somewhere or something, or I don't know. Okay,
So we just thought that you were dictating.
okay. But generally, I write no. So anything, it's okay. Doesn't matter. Now, see the logic about it is if capital employed, the total amount of capital employed, if it is 100%, the profit which is available to all of them, which is EBIT, is what percentage? So that's the logic. Now we are going to the PPT. There's something which you have to note down here very carefully. Observe this one. Return on capital employed is equal to operating profit or EBIT. Interchangeably, these two terms are used because assuming that there are no non-operating incomes or no non-operating expenses, we talk about both of them as who's Priya Kumari? So many times you log in, it is so distracting also. See, EBIT or operating profit is interchangeably used. So, operating profit divided by the total capital employed into 100. That is percentage into 100. That's the equation. Then we have already learned about how do we calculate the profit margin. Profit margin, any profit, profit divided by sales into 100. Okay. So we see that there are other terms also apart from ROCE. We also have other terms called as ROI, ROA. The other terms of profitability. So in the question, they may also mention about what is return on investment, ROI. Then we also have it as ROA, return on assets. Basically, the equations talk about return on investment is equal to return, that is profit divided by investment. Then return on assets is equal to profit divided by total assets. We see that the numerator in all the situations is profit. Profit divided by, here it is investment. Then return on assets, it will be profit divided by total assets. Profit divided by these variables, the denominator variable. Denominator variable, see total capital when it is raised, what is that? Another term for that is nothing but investment, the total amount of investment which is raised from various sources of capital. Why are they raised? They are raised to be invested into total assets. So the terminology which is used in the question, if we have it as capital employed, we go with calculation of ROCE. The terms which are given is investment, we go with ROI, or if it is ROA, that is only assets are given, we call it as ROA. Technically, there are very intricately when we look into that, there are certain differences, but because we are not looking into the calculation part of it, see down the line you will become ACCS, joining the organization with a professional qualification, so you would not be placed at at an accounting level. So, with that intention, so much of emphasis on observing the intricacies is not included. You just have to understand about what these ratios are, how do we interpret, what analysis can be taken up. Fine. So, at this point of time, just understand that these terms can be interchangeably used. That is ROCE or ROI or ROA. ROCE, the total amount of capital which is raised, is the total amount of investment also raised. Investment raised to be invested into total assets. Then this ROCE can be elaborated. So in the formula says operating profit divided by the total liabilities, the total capital employed. That is the debt liability and the equity liability added together, non-current liabilities. Done. The formula numerator is operating profit, denominator is capital employed. Done. There is an analysis in ratio analysis called as DuPont analysis. DuPont, D-U-P-O-N-T, DuPont analysis. So wherein DuPont analysis says that ROCE can be calculated as profit margin. So there are two aspects which have to be looked into. First part of it is profit margin into asset turnover ratio. Profit margin, I'm writing it as M margin into asset turnover ratio. Asset turnover ratio. So when it is presented in two different things, that is, it is split into two different parts. The first part of it talks about what is the percentage of profit which they have earned. Sometimes by charging higher selling price also, the sales value can be increased. By selling more number of units also, sales value can be high. So there are two ways in which the sales value can be high, either by increasing the selling price and making more amount of profit, or by selling more number of units and increasing the sales. So either ways, sales can be high. Which one is efficiency? When they sell more number of units, it is efficiency, because increasing selling price is a short-term strategy. Because once the customers have an alternative that some other supplier is supplying it at a lesser price, then we see that the customers move to the other supplier. Fine. So it is a short-term strategy. Um, it would not last for a longer period of time. So here we see that, is there profitability that is written on capital employed on account of higher profit margin, or on account of selling more number of units? Asset turnover ratio. This talks about any amount of investment which is made into assets. It can be converted, if it can be converted into sales. See, all turnover ratios basically talk about the activity level. So the activity is by selling goods. So here in place of capital employed, if we write assets, because they are interchangeably used. So the assets, investment into assets, if they can be converted into very quickly into sales. So that's asset turnover ratio. So are they efficient? Are they being able to convert the assets into turnover? Indicates the efficiency part of it. The first part of it indicates the profit margin. So profit margin into asset turnover ratio. Profit margin is profit by sales. Asset turnover ratio is sales by assets. Right? Ultimately, we see that revenue gets cancelled. We have operating profit divided by capital employed or assets. Capital employed or assets or investment, anything. So basically, we have the same value, but then it can be um, deep into that, we can further investigate what is the reason for a higher ROCE or lower ROCE, and then interpret better when it is split into two parts, which is written on sales or the profit margin into asset turnover ratio. So that gives us better insight. So if somebody asks you to talk about whether their position, their profitability position is good or bad or anything, so the immediate thing what one can take up is the profit margin, but that may not explain the complete picture. So what we can do is we can calculate what is ROCE by using DuPont analysis, that is profit margin into asset turnover ratio, talks about where is their efficiency. Is it because of adding high profit margin, or by able to convert their investment into sales, selling more number of units? So that can be understood. Okay, so under from balance sheet, we can also calculate ROI. If the terms mentioned are investment, we calculate ROI. If we have the assets, we can calculate ROA. Then there are certain other things also which are calculated. That is, what is the profit available to each shareholder, etc. EPS and all. When the time comes, I will also explain. But those things again you will learn in financial management in thoroughly. Um, Maybe that would not be highlighted so much here in management accounting. The next set of ratios are liquidity ratios. Liquidity ratios, they talk about the short-term position, how sound is the business in the short run. So generally that is a period taken for 1 year or operating cycle, whichever is longer. So the current assets are those assets which are converted into cash in a period of 1 year or operating cycle, whichever is longer. So that is the um, meaning of what is current assets. Current liabilities are those liabilities which have to be discharged in a period of 1 year or operating cycle, whichever is longer. So it is a short period of time which is taken into consideration. See, in the short period of time, if they are able to meet their responsibilities, their liabilities, then it is considered to be as sound. They're doing well in the short run. Fine. Now, because of the operating activity, because of investment of amount into short-term assets, the raw material is purchased. Already we've discussed about the operating cycle many times. So cash is invested into raw material. Raw material gets converted into finished goods. Then the finished goods will be converted into credit sales. So what we call it as accounts receivable. At the end of the credit period, the accounts from the accounts receivable, the customers pay and then cash is realized. So there is an investment to be made into operating cycle. So cash is blocked in operating cycle. Cash is blocked in operating cycle. Huge amounts of cash balances are also not maintained. Why? Because cash kept idle does not give any return. So earlier when we were doing cash budget, I have explained to you. Cash kept idle does not give any return. So therefore, they focus on investing into these current assets. Done. So if cash is blocked in current assets, then if they require to pay the liabilities, that is when they purchase material, when they pay various expenses, then they have to meet certain obligations like salaries, wages, rent, etc. For all these things, cash is required. So if cash is invested in current assets, cash would not be available. But then cash is not invested forever in current assets. It is a short period of time. So it's an ongoing process, it's an ongoing cycle where amount which is invested gets converted into cash. This cash can be used to repay all those things, liabilities, meet expenses, etc. So for that reason, how much should be their current assets? And because current assets, it's an ongoing cycle. They get converted into cash again. After they get converted into cash, then again they start the activity by purchasing raw material. It's an ongoing process. So from time to time, we see that there is cash which is which comes back. The cycle is completed, cash comes back. So it's not that forever they are left with no availability of cash. The cash balance is available to them after intervals. So at that time, they can manage to meet their expenses. So the short-term position can be calculated by way of calculating liquidity ratios. So there are two important things, two important ratios under liquidity. The first one talks about what is current ratio, the relationship between current assets and current liabilities. So in what proportion are these two things available? See, ideally speaking, they say that double the amount of the current liability should be the current assets. Current assets should be double the amount of current liability. So, in this cycle, when it is still carrying on, sometimes when the cash is realized, that can be used to make the payments. Okay. So, ideally speaking, for a manufacturing business, it can be as much as 2:1. Then we see quick ratio. Quick ratio is equal to, see what do we have under current assets? We have cash, all types of cash, cash in hand, cash at bank, cash in the form of marketable securities. Very easy to sell them in the market, marketable securities. Apart from that, accounts receivable, then inventory, then we have prepaid expenses, short-term advances. All these things are part of current assets. So out of this, we see that inventory is not a very quick asset. because it has to get converted into finished goods sold as current credit sales, and then so it gets converted in a period of 1 year, but it is not very quick in nature. It would not get converted very easily. So what are the quick assets? If we take into consideration, quick ratio is equal to quick assets by current liabilities. What are quick assets? Every other asset is a quick asset other than two items. One is inventory, another one is prepaid expenses. So when there are no prepaid expenses, it's only the inventory which is deducted from current assets. So quick ratio is equal to quick assets by current liabilities. So quick assets are current assets minus inventory minus prepaid expenses. So this indicates that very quickly what are the assets which are available, which can be converted into cash so that the current liabilities can be met. So they say anything between 1 is to 1 and 1.5 is to 1, it is considered to be as an ideal quick ratio. Then see, the third category is mentioned here as activity ratios. So activity ratio is basically, it talks about the amount of investment made into any type of an asset. Now that should result in an activity being generated. Activity is nothing but sales amount which are generated. So they have to be reflected in sales, or they have to reflect in an activity, very specifically activity. The activity is high, it is considered to be as efficiency. So activity ratios are also called as efficiency ratios. Okay. Um, with the current assets and current liabilities, activity ratios are given. But in the previous slide, we have looked into one activity ratio, which is the capital employed versus the revenue. That is the activity of asset turnover ratio. Do you see that? So asset, the investment made into assets, whether it is able to convert it into sales. First one here in the list which is given, under activity ratios, the first one, I will mention it here. What is inventory turnover ratio? I hope you are able to see the word file.
Yes, ma'am.
Okay, done. Any turnover ratio, one easy way to remember turnover ratios is, see, turnover ratio, any turnover ratio, there would be two variables. One is turnover and another variable, whatever is connected to that. So a prefix of in or a first word which is added in the turnover ratio. All turnover ratios, we see that turnover will be there in the numerator. So we in the numerator, we see turnover would be there, and the denominator, the other variable will be there. So if it is inventory turnover ratio, turnover will be in the numerator, inventory will be in the denominator. Receivables turnover ratio, turnover will be in the numerator, receivables in the denominator. Asset turnover ratio, turnover in the numerator, assets in the denominator. Capital turnover ratio, turnover in the numerator, capital in the denominator. So it goes on like that. So that is one blind rule you just remember. Now here we see it is a turnover ratio, inventory turnover ratio. So what is turnover? Turnover is the level of activity. Now level of activity, it is basically turnover is also known as sales. So we have it as sales. The numerator should be sales. So I will write it here. I will scribble here. I will again write it. uh, So if it is in the numerator, we would have it as the sales. Sales divided by inventory. Turnover is sales. But inventory is always valued at cost price. Sales is cost plus profit. We have sales always given as cost plus profit. Okay. There is a profit margin added to the cost. The cost of the units sold plus the profit margin is sales. Denominator variable is inventory, which is always valued at cost price. Fine. So then there would not be the right match. So what is done is from the numerator sales, profit margin is eliminated. So we call it as cost of goods sold. And that's the numerator divided by inventory. This is multiplied into 100. Then we see inventory days is equal to in connection to inventory turnover ratio, we have inventory days is equal to a year has 365 days. 365 days, sometimes it's 360 days divided by inventory turnover ratio. So, but within what does it indicate? It says that in a year of 365 days, how long inventory was held, cash was held in the form of inventory. So, number of days of inventory or number of days where cash was held in inventory. I explained to you about the operating cycle. Raw material has to be converted to finished goods, then sales, then cash. So how many days does it require for them to have this investment held in inventory, or we call it as stock holding period? How long the stock was held by the business, stock holding period? Next one is receivables turnover ratio is equal to, the numerator will have sales. What are receivables? Any one of you? What are receivables? Any one of you, please elaborate on what are receivables. Any other term for receivables? No one's listening to the class. No response is coming. Do you know the meaning of receivables? Credit. Credit what? Credit is right, but what credit? Credit very specifically come down. Are you aware of the term debtors? Do you know what is the meaning of debtors? Debtors. What are debtors?
Debtors are the people who owe us money.
Who owe money to the business. Why do they owe money? Did they borrow from the business? Why do they owe money to the business? That's it. Credit sales. Because of uh, selling goods on credit basis, they owe money to the business. So they are called as sundry debtors or whatever is the term. Another term for debtors is receivables. So either we call it as debtors turnover ratio or receivables turnover ratio. It means the same. So I was explaining to you the logic about BC. It is sales. Numerator should be sales or turnover. Sales divided by the other variable is receivables or debtors. Now, see, receivables is on account of credit sales. So the numerator should be credit sales. Instead of total sales, it should be credit sales. So let's mention it here. So we have receivables day. Did you learn final accounts in your college? Then we have payables. Who are payables? Now you should be able to tell. What are payables? The term payables, what do you mean by payable to someone, but on account of what? The opposite meaning, no? So just mention that. That's it. Credit purchases. Simple. It's credit purchases. So can you give me the equation? Credit purchases divided by the activity is related to this time it is purchases. On account of purchases, any amount which is due to be paid to the suppliers. So credit purchases divided by payables into 100. Now we have payables days is equal to 365 days divided by see in each context we see that the meaning for turnover has differed. Sometimes it is cost of goods sold, sometimes it is credit sales, sometimes it is credit purchases. In asset turnover ratio, so any other turnover ratio like asset turnover ratio, fixed assets turnover ratio, capital turnover ratio. So in each of these things, we just go with the numerator as sales. Now, each of these situations, the numerator has taken a different form, whether it is sales, whether it is cost of goods sold, whether it is credit sales, whether it is credit purchases. See, different things are given, but the logic is about whether there is any activity which is reflected. Because amount is invested into something, is that resulting in an activity taking place? So that is the point what we have to learn. If there is more amount of activity, then they are called as efficient. So they are also called as efficiency ratios. They are considered to be as efficient, otherwise not. So here we see that inventory days are calculated as inventory by cost of sales into 365. So this is the other way around, which is there um, in the denominator. When then there is a fraction which comes to the numerator, the numerator into the reverse of the fraction. So that is what is basically given here. So inventory days, receivables days, and payables days. So with this, we can find out what is operating cycle days. Operating cycle days is equal to inventory days we have inventory days plus receivables days minus payable days is called as operating cycle days. That is what one thing we can find out. So for the entire operating cycle to be completed, how many days are required? So that can be calculated. Inventory days plus receivables days minus payable days is equal to operating cycle days. Then we see we've learned about short-term solvency, short-term position, whether they are sound in the short period of time, whether they are able to meet their current liabilities, because they maintain double the amount of current assets. So when the current assets get converted into cash, so some cash will be available to meet their current liabilities. The balance of it can be again reinvested. So it is an ongoing process. Therefore, ideally speaking, they maintain double the amount of current um, whatever are the current liabilities, double the amount of current assets are maintained. So that is what is looked into or understood from the short-term position. So when we talk about a short-term position, we should also talk about the long-term position. So in the long run, what is their situation? So the long-term position also has to be understood. So the balance sheet, we see that on the liability side, we have the current liability, then we have the debt or the long-term liability, then we have equity. So the long-term position, when we are talking about all the funds are raised to be invested into current assets, plus another type of asset is fixed assets for a longer period of time. There can be profit earned from fixed assets, but it's very difficult to convert them back into cash. Those are fixed assets. Now we have mentioned that for the long run, there are long-term sources of capital which can be raised. One is long-term capital or debt capital. Another one is equity capital. Okay. Debt capital and equity capital. There are features of debt capital and equity capital. Debt is invested by outsiders. We see that there are two types of capital, debt capital and equity capital. So in terms of cost and risk. So how do we understand or what are the points of difference on about debt and equity? In case of debt capital, we see that cost is low. It is a cheaper form of capital. In case of equity, it is a costlier thing. The cost on equity capital is high. In case of risk on debt capital, we see that risk is high and equity, the risk is low. Let's quickly try to understand what is the reason. See, debt, when once it is issued, so there is an interest rate which is decided. The same interest rate will hold good for the entire life of the debt capital. Let's say if it is for 10 years, so at the time of issuing, whatever is the rate that is applicable for the next 10 years. Even if the interest rates rise also, we do not see anything happening with debt capital. So over a period of time, they are continuously paying the same amount of interest amount. It becomes a cheaper form of capital. On the other hand, equity is a costlier form of capital. Why? Because the equity, um, they the profit which is earned by the company belongs to the equity holders. So the total amount of profit um, is ultimately paid to the shareholders. So whether it is paid now or later on, it is paid to them. So they expect that the company earns better profits for them. When they expect better profits to be earned for them, so the company is under an obligation to earn higher returns. They are always on the pressure. If they do not earn higher returns and pay them better returns, then there is a danger that they may withdraw their investment, that is sell their shares in the stock market and then withdraw that. That will have a negative impact on the company. So on that note, the company is always under an obligation to earn higher profits and then pay them higher returns. But technically, there is no obligation. See, we see risk is higher in case of debt capital because um, interest has to be paid. It is mandatory that interest has to be paid whether the company earns profit or not. We see that interest amount should be paid, plus at the end of the life of the debt capital, the total amount has to be repaid to the debt holders. So for that reason, we see that um, risk is high in case of debt capital. So because funds are not always available in the form of cash that they can meet all the payments. We already have understood that cash is already invested into some form or the other. It is not a simple task that cash is available and then use the cash and make the payment. That is not a possibility. So what we see here is the risk in case of debt capital is high because from time to time when the payments have to be made, in that case, they have to make arrangement for cash. So risk is high. Then um, when profits are available, only then dividends are paid to the shareholders. So on equity capital to the shareholders, dividend is paid when there is a profit available, and there is no lifetime um, for share capital which has to be paid back to the shareholders. So as long as the company exists, the share capital will be there with the company. The company has no obligation, under no pressure to pay back the share capital to the equity shareholders. So risk is low, but cost is more in case of equity capital because of the expectation. See, when they sell away their shares, the company will not pay them, but some other investor will purchase them. So, like that, everybody starts selling, the share price in the stock market falls. So, with the fear that such a thing would happen in the stock market, they all the time put an effort to satisfy the shareholders. So, on that note, they are under an obligation to earn better profits and pay them better returns. Fine. So there is a matrix here. There is a 2 by 2 situation which is present. We see if it is debt capital. What is the cost? If it is debt capital, what is the risk? If it is equity capital, what is the cost? What is the risk? So we see there is a set of advantage, there is a set of disadvantage. So in such situation, what do we see is when capital is raised. Now capital, that is debt and equity, relates to the long term position. When it relates to the long term position, in the long run, how sound are they in terms of what is the risk which is present, what cost are they paying? So that is what has to be looked into. In the long run, what is their position? What percentage of it is by way of investing into risk related funds? So the formula talks about what is the capital gearing. Capital gearing is what is the proportion of debt versus equity. Debt, what is the percentage of debt amount versus what's the percentage of equity amount? So debt capital versus equity capital. See, each of them have one set of advantage and one set of disadvantage. So both of them are advantage in some way and has a disadvantage in another way. Ideally speaking, this should be 1:1. So as much as debt is employed, that much of equity also should be employed. More the equal part of debt will enable them to cut down on their cost. Equal part of equity will enable them to minimize their risk. So to have a better hold on these two aspects, so the ideal situation should be 1:1. They are mentioned as debt, capital gearing ratio, debt by equity ratio, debt ratio, which is debt by total assets, or proprietary ratio, owner's equity by total assets. So basically, they talk about what is their position in the long run, a period which is more than 1 year. So that is how it is calculated. Then we have coverage ratios. See, I'm taking you to the Word file. EBIT is the profit which is available to all the investors, already discussed. So whether EBIT is sufficient, yeah.
Ma'am, in receivable days, it should be receivable turnover ratio, right?
What did I write something else? I'm really sorry. Is that so? Is that the mistake I made? Huh. It should be receivable turnover ratio. Maybe looking at the previous thing, I just wrote it like that. I'm really sorry about that mistake. Please make the change. It is receivable days is equal to 365 days by receivables turnover ratio. Please make the change. Okay. Where are coverage ratios? Coverage ratio is equal to, so this is the profit which is available to meet all the finance costs, that is interest cost, preference dividend cost, equity dividend cost, all these things are met out of EBIT. So the coverage ratios, the base here is how much profit is available to cover various expenses. That is, coverage ratio can be given as, we are going back to the PPT. Coverage ratios are given as interest coverage ratio, fixed charges coverage ratio, dividend coverage ratio. So the logic here is what is the operating profit or EBIT, whether that can cover the interest expense. Interest expense is also a fixed expense because interest rate is fixed. So interest amount is always a fixed cost. So fixed finance charges, what we call it as. Operating profit by interest expense. So EBIT by interest. That is how the coverage ratios are calculated. Whether they have sufficient amount of profit available to cover their finance cost. That is the logic here. There are various forms also which will be taken. That is dividend coverage ratio, fixed charges coverage ratio. Just take it up. I hope till here it is you understood. Did you understand the explanation? See, the practice only generally the regular BCom program and all, we spend at least 15 to 20 days on ratio analysis. In one single shot, if the entire chapter has to be understood, it is a task only. But if you have understood the concept while practicing, this would be helpful for you. So in your college also, you will definitely be working out questions based on ratio analysis and take up certain things. There's no doubt about it. But at that time when you are working, um, if you understand it, you can take up the questions when you are working out in the college. Next category here in this particular PPT, another category which is mentioned as divisional performance. So what's divisional performance? In certain situations where organization size is very big, the organizations are big enough, in that case, managing the organization as a whole is a difficult task. So what is done is they go for decentralization. That is, they divide the organization into smaller parts. We call them as divisions or departments. Divisions, departments. What is special about that? So when they are divided into these divisions, each division based on some attribute, maybe based on function, based on some work, nature of work which is carried on, some activity which is carried on, some way they are grouped together. Group Certain set of employees are grouped together, they form a division or department or unit, anything which whatever is the term which is used. So these divisions have a manager appointed. The manager is given some authority to take decisions, and based on the decision taken, the performance is measured and then later on evaluated and made responsible for the decisions. So we also call them as responsibility centers. So if they are divided into divisions, the evaluation based on the division or the performance of the division, certain ratios are calculated. First one is ROI. ROI, just now I have explained to you, it is used as an interchangeable term with ROCE. So there it talks about what is profit divided by capital employed or profit divided by investment. So we see ROI is equal to controllable profit divided by controllable capital employed. What does it mean by controllable profit? So which is there under the purview of the manager, those costs which he can control, only those controllable costs which are considered, any controllable profit which is earned, divided by the capital invested into that unit, that division. It's compared and then multiplied into 100 is ROI, return on investment. Okay. Then we have another term, RI. RI is residual income, controllable profit minus interest on capital. Why are we calling it as notional? Technically, owners are not paid any cost. Interest is not paid on capital. There is no day where the business would literally pay some amount and then owner collects it from the business. It is there in the business, but it is an adjustment which is allowed under the principles of accounting. So we write it as an expense. It is an imaginary transaction taking place, but it is accounted as an expense, business expense. So here we write it as notional interest on capital. So from the profit EBIT, after the cost of capital is deducted, is there any more leftover profit, residual, any leftover profit available? Okay, so that is how these things are calculated. All of them till now, what what I have explained to you. Of course, you will be taking up the numerical questions in your college. Please thoroughly practice. Um, all of them will repeat again in PM, but maybe explanation would not be given at that level. APM, it will not be repeated, but it will be included in the cases. Assuming that you've already learned that thoroughly and you have a better hold on these terms, they will be tested. See, basically, PM and APM are performance management, performance measurement, advanced performance management. So they are focusing on measuring the performance. The best tool what is available is by way of ratio analysis. So ratio analysis is one topic which you have to learn. Remember that for a lifetime. You can at no point, I just gave you the gist, but when you actually start practicing, there is so much more to that, so many things to remember, so many ways in which the performance can be measured. So all these things should be understood thoroughly, and then remember that in organizations, when you start measuring the performance, the best tool what is available is, because the financial statements would be available, so ratio analysis is the best tool, so that will be used. You cannot afford to forget anything under ratio analysis for a lifetime. I'm not talking about for till you pass the exam. Even after you join organizations, you will be using this tool very frequently. So in APM exam, when they talk about a particular scenario, particular question, particular case which is mentioned, there you would be expected to take up the analysis, measure the performance, and then give your comments. So what tools will be available? There is no hard and fast that this ratio only, whatever is suitable to that particular scenario, take up that calculation. Sometimes in APM, they work out the ratios, they calculate the ratios, the values will be given to you. You have to interpret them. So from today onwards, just understand one thing. You have to learn ratio analysis, and that too thoroughly, perfectly well. You have to learn that. Then coming to the non-financial performance, see, all this while what we were talking about is all about financial performance. There are certain aspects other than financial aspect, which is non-financial performance also. There are non-financial factors also in an organization which have to be measured. The non-financial parameters are in terms of satisfying the customers, in terms of efficiency, in terms of productivity, in terms of flexibility which is provided, that is customization, delivery, etc. In terms of maintaining a good rapport with the suppliers, in terms of taking care of the employees of the organization. All these are non-financial parameters, non-financial performance indicators. So these things also have to be taken care of. So first thing is productivity. The first ratio which is given is the product the production volume ratio. If the budgeted production hours are taken as 100%, the actual output measured in standard hours. So um, how much is how much time is required for the actual output produced, that is actual output measured in standard hours, is what percentage. Then capacity ratio, when they have budgeted production hours decided, how much did they consume, actual production hours work, is what is capacity ratio. Efficiency ratio talks about actual production hours worked compared to actual output measured in standard hours. So that is about whether they were efficient, whether they were efficient when the budgeted hours are compared with the actual hours consumed. So these are other things other than the ones which are taken from the financial statement. These things talk about their productivity, efficiency. So that is also to be measured. Non-financial performance. Then they talk about quality. Quality is an issue whether see maintaining the best thing, the best aspect in the organization in terms of producing their products and services, the best methods which are adopted to ensure that there is no defective product produced, there is no um, low quality of service provided. So that has also to be taken into consideration. So when we are talking about measurement of performance, quality is another aspect. So the quality aspect also has to be taken into consideration. Poor quality products or services will lead to loss of business and damage to the business reputation. So for that reason, um, they have to put in various efforts to ensure that the production is of quality production, quality products and services are produced and delivered to the customers. Examples of non-financial performance indicators, NFPIs, that could be used to monitor quality both from an internal and external source are: what are the wastage levels, internal reworking of finished products, that is when they produce the product, the final product which is produced is a defective one. Defective products cannot be delivered to the customers. So what is done? The product is again worked on. There is some more effort put in to make it as usable, to make it as a quality product. So they have to spend some rework cost on those defective units. So internal reworking of finished products, minimizing on the customer complaints, taking up the delivery at a faster pace, speed of delivery, accuracy of delivery, number of returns. Some more things are flexibility to the customer, customization, delivering at the convenient position, convenient location of the customer. So taking up certain things. Then we see taking care of the employees, their skill enhancement, training to them, various aspects are to be taken into consideration. The relationship with the suppliers, customers, the relationship, how it is maintained. So, okay, there is a doubt here. See, ratios, some of them are expressed as 100%, some of them are expressed as time. When the ratio, the numerator and denominator, the fraction, it is multiplied, immediately is converted into percentage. But when you don't multiply it into percentage, you talk about how many times is the numerator versus the denominator. So the ratio will be presented as times. How many number of times? How many times is the numerator as compared to the denominator? So what did you do with the ratio, whether it was multiplied with 100 or not? If it is multiplied into 100, it is called as a percentage. If it is not multiplied into 100, it will be expressed as number of times, or how many times is to the numerator is to how many times the denominator. Let's say numerator is double the denominator, 2 is to 1. So numerator is double than the denominator. So expression could be anything. Expression, the way we want to express that, we can depending on what we have done in the ratio calculation. We can also multiply it into 100 or not multiply into 100. That is also fine. Did I address your doubt? So now there is one model which is given, which we call it as balanced scorecard. Now we are doing this topic called as performance management or performance measurement. Measuring the performance, how did they perform? See, for a small organization, simple with less complicated activities, measuring the performance is not a task. It is not an issue. It can be easily measured. But if the size of the organization is big, there are multiple activities, there are complex functions which are taken up in the organization. Measuring the performance of the entire organization as a whole may not be a possible task. So for that reason, Balance scorecard suggests that the entire organization should be looked into from 4 different perspectives. One perspective is finance. The other three perspectives are non-financial perspectives. One is customer. Another one is internal business process. The third one is learning and growth. So these are the 3 non-financial performance aspects, perspectives. What does this balance scorecard suggest? After the organization is looked into from 4 different perspectives, each of this perspective, it should be understood from what are there is a concept called as CSF. CSF stands for critical success factors. So what are those factors which can ensure them success? Critical success factors. So if we are talking about under financial, so what we have learned under ratio analysis, all of them can be brought under here. It could be about sales. The more sales, better is that for the organization. Sales is one factor. Profit is another factor. Liquidity one factor. Profitability part of it. Then we see efficiency, that is more activity ratios happening. Then we see we can have a risk aspect, that is capital structure, what proportion capital is employed, etc. So first step is identify what are the critical success factors. Under each perspective, first step is to identify CSFs. Mere identifying the CSFs will not serve the purpose. So these CSFs also have to be measured. What is sales? If we define that sales is one crucial factor for success of the business, is that sufficient? We should also observe how sales is performing. Is sales the same, or it is decreasing, it is increasing? What is it? Compare it with some competitor in the market. How much is the sales value of the competitor? How much sales did they make, etc. So here we see that people are entering the class now, I think for attendance sake. So sales now has to be measured, whether period after period, whether sales is growing or not has to be measured. That has to be understood. They have to look into whether there is a possibility, whether there is any growth happening in the organization. So every CSF has to be considered as a possibility to measure the performance. If it is profit, whether profit is growing. If it is liquidity, what is the working capital? What is the current ratio? What is the quick ratio? So every variable, if we are talking about debt equity, what is the proportion of debt equity? More debt or less debt? That has to be measured. So everything, whatever we first identified to be as CSFs, have to be measured with the help of, we call it as KPIs, key performance indicators. For example, if we are talking about sales as one factor. So we can check here whether there is any increase or growth in sales. Whether there is any growth in sales. So that is how it has to be measured. And then we have to continue in that particular fashion. So every CSF which is identified has to be measured with a KPI. Then the non-financial performance or non-financial perspectives. If we talk about customer satisfaction is one important factor, critical success factor. So if we are talking about customer satisfaction, how do we know? By way of taking feedback from the customer. So a questionnaire is circulated, some feedback is collected, online feedback is collected, some way. Okay. Then are they repeated customers? Are they do they come back again and again? That has to be known. How can it be known? When there is a customer relationship management maintained by the organization. Earlier also, I think I have explained that there is a relationship maintained with the customers by making them as members, asking them to subscribe to their features, taking the phone number of the customers and feeding it into the system, ensuring that they earn certain points. So keeping a track of what the customers are purchasing. So whether sales are increasing, new customers are being added. So now it is possible with the customer relationship management, whatever are the tools which they are using. So they can understand about customer satisfaction. Internal business process, it talks about efficiency, it talks about quality, it talks about um, is the workplace safe, is it prone to accidents, etc. So various things. How do they take care of the customers, the delivery to the customers, flexibility in terms of delivery or customization, flexibility in terms of production, etc. Then finally, learning and growth. Learning and growth talks about employees. The employees aspect is considered under learning and growth. So if it is employees, then is the skills of the employees enhanced? Do they take care of the employees? The skill part of is it enhanced? Whether training is provided, whether feedback is collected from them. After providing the training, did their efficiency increase? Like that, the learning and growth aspect also has to be taken into consideration. So balance scorecard suggests that the organization should be looked into from four different perspectives. Each of these perspectives, there should be CSFs identified, and all CSFs have to be measured with the help of KPIs. Then it it can be possible to understand how each perspective is functioning. Okay. One major disadvantage what we can um, quote in case of a balanced scorecard, it looks quite interesting that we can simplify and then learn about the performance of the organization. But one major disadvantage what we can see is um, we can know the performance of each perspective, but we cannot know the performance of the organization as a whole. That is not possible to know. Okay, that is one major disadvantage. Of course, um, at an advanced level, you can also talk about other disadvantages. I hope that is clear. Balance scorecard.
Yes, sir.
The next topic is benchmarking. Benchmarking is setting something with as a benchmark or as a standard. See, when performance has to be measured, there should be some standard. See, for students also, The benchmark is something which already someone has achieved. Someone has become a university um, winner, I mean, gold medal winner, or university topper, or someone who's earned a medal at the university level, something. So that is now set as a standard. So every time when the performance of the students, them to motivate them or to encourage them to achieve something, then the one who has achieved an award at the university level, or someone who's a topper at the university level, their reference would be taken, and then students are motivated to achieve something like them. Why? Because they've already achieved something which is I mean, worthy, or note taking that. So they have already achieved something. So their performance is considered to be as a benchmark, or as a standard. Done. So by deciding a benchmark, also the performance can be measured. So what is done? The comparison. See, the performance of the benchmark is first taken into consideration. How is the performance measured? Anyway, either performance by financial perspective, non-financial perspective. We've learned a big list of performance measurement, that is ratios can be calculated, um, customer aspect, employees aspect, many things. Just now we finished the entire list of it. Okay, many more can be included apart from this also. So those things are first measured and kept it. Next, the entity whose performance has to be measured. Let's say that XYZ is considered to be as a benchmark. XYZ is considered to be as a benchmark. If there is another entity called as ABC. Now, ABC performance will be measured or compared with the performance of XYZ. So, individually, each of them, their performance will be mentioned. Whatever are the tools which are used, those tools are taken into consideration, and the performance is measured. Then, the next step is um, they are used to compare. So ABC's performance will be compared with the benchmark XYZ's performance. So that's how, on comparison, certain suggestions can be made, because XYZ has achieved something remarkable. So efforts can be put in to achieve something what XYZ has achieved. It's not always that in all parameters the benchmark would always be the best. Sometimes some of the parameters, other entities also can be better. So the whole concept of benchmarking is decide something to be as a benchmark, measure the performance of the benchmark, and also measure the performance of other entity. Then later on, compare the performance of the benchmark and the entity. So that is the process of benchmarking. Benchmarking can be taken up at the strategic level wherein um, the organizations in the industry at a strategic level, they can be compared. Internal, that is internally one department can be compared with another department. Competitive, peers for someone who are equal or um, similar to each other. So peers or competitors. So that can be taken up. Functional level. See, one operation, one function. Let's say if you're talking about HR activity in one company, a similar company, what is the HR activity there? So the function or operation in one organization is taken to be compared with the operation or the function in another organization, similar organization. So that is functional. Anywhere in, whether it is internal or at the organization level, comparison between the competitors at the strategic level, any level, when there is a comparison made, we call that as benchmarking. Of course, we have learned about these things. Only the contract costing I have not explained. Job costing, when one job is taken up and on completion of the job, all the costs are accounted for um, specific to that particular job. So that's job costing. When the work is completed in more than one stage, wherein the material moves from one stage to another stage, process costing is adopted. When the production is taken up in batches, in lots of units, each batch, what is the total cost when it has to be ascertained, we use batch costing, similar to job costing, but there it is per job. Here it is one lot of material, one batch of material produced. Contract costing is, see, when the nature of work is over a long period of time, on completion of the contract, the see which is spread over a long period of time, the total profit can be realized. But waiting until a long period of time not realizing anything also would not be appropriate. So what is done is, at the end of each year, partially whatever is the work completed, to that extent the percentage of completion is accounted, and to that extent amount of profit is also proportionally calculated. So period after period, as long as it is spread over, so period after period, based on whatever is the percentage of completion, the accounting will be taken up. Let's say construction of buildings, construction of the infrastructure, those facilities like big bridges or roads or dams and all, they're time taking thing. The building of apartment or something like that. So basically it's not completed in a short period of time. A very long period of time is required. So do they wait until the entire work is done and receive the revenue from um, the concerned person? So would that be appropriate? No. But then they also require to invest in amounts into various costs. So partially they have to be collecting the amount from the concerned party, then take up the work. So in this process, at the end of each period, proportionate amount of the activity which is carried on, to that extent the profit is also calculated and accounted under contract costing. In case of service sector, already we've discussed about what are the points of differences between um, manufacturing businesses and service businesses. So in case of service sectors, in terms of financial aspects, what is taken into consideration, we have discussed about various ratios. Out of that, those ratios which are applicable for service sector, so revenue per product group, staff cost as a percentage of revenue. I have mentioned that expenses also can be compared as a percentage of sales or revenue. Okay, space cost as a percentage of revenue, market share. Okay, current ratio. These are the things which can be present in numerical values, numbers, figures. Quality aspect of it, depending on the customer survey feedback collected from that, they can understand about the quality aspect, whether they conduct inspections from time to time, inspections when the production is carried on or when they are rendering services at that time, how are they delivering that? So that is inspected from time to time. Have a fault monitoring system present there. So there is any fault which takes place, how do they take care of that and see that it doesn't repeat again in future? Quality control, um, putting in efforts to ensure that there's no defective work which is carried on. Quality control. So that should be taken into consideration. Did you understand what we've done? Because very few are left. I mean, the not-for-profit organization, that's the only thing. Cost control and cost reduction. Then tomorrow's class, within no time, that will be done. And then spend some time on few ratios and few standard costing questions. So that would be the syllabus. So tomorrow's class would be the last class. Anywhere, because it's a very lengthy class I have taken, at a stretch for almost 2 hours, I have explained all my sympathies with you in terms of you listening to in the afternoon hour, listening to so much of content. But this is all important that we have to remember, learn that. At any point of time, do you have any doubt? You can please ask, clarify your doubt. I asked you one question. Who's Farhan Khan? From which college is Farhan Khan?
GCU.
GC. Why is he not switching on the audio? I remove him from the class, then again he comes back. I expect that he would again connect to the audio and then he doesn't do that. Give his attendance. Let me check that. Any doubt? Anything, anyone, any ratio, any part of the performance management part? Yes, Ashwin Kant. Ashwin, did you raise your hand? Okay, reps of these two colleges, please send attendance to my WhatsApp number.
Yes, ma'am.
Ma'am, I've already sent it, ma'am, to your number.
No, today's, I'm saying today's attendance.
Okay, ma'am.
Yeah, today and tomorrow. Tomorrow only you send it for both the days also. That's perfectly fine since you've given me for the rest of the days. So tomorrow, if you give me for the other 2 days, that's fine.
Ma'am, where to find these recorded videos?
I still have not uploaded. I will let you know because these things will be uploaded in LMS. It is because yesterday only during that we got to understand how to do that. Earlier also it was told, but I was unable to understand and upload it. I put in. I have tried uploading it. It didn't work out. So maybe in a day or two, all the recordings will be uploaded. So maybe tomorrow I'll give an update on how to view the recordings.
Okay, ma'am.
Anything else?
Ma'am, will you share us this PPT?
Definitely. Now, if you have logged in from your from laptop, you will be able to see that right now. In the chat box, it would be there. I'll put it here. Otherwise, reps are in touch with me on WhatsApp. No, I'll send it to them and take it from your reps. Because this is see those who log in from their mobile phones, they will not be able to even see that. So that's again a risk thing. I'll send it to the WhatsApp of your class reps. please take it from them. Right away after this class, I will send that.
Okay, ma'am. Thank you, ma'am.
Anything else?
Ma'am, and also better share us that Excel sheet, ma'am.
Okay. Done. The ones where been tomorrow I will share the Excel sheet because tomorrow we will be taking up certain questions. We'll work out some more questions. So because all of them are in the same Excel sheet. Tomorrow's at the end of tomorrow's class, I will send that Excel sheet. But today I will send PPT.
Okay, ma'am.
Fine. In that case, shall I end the class here?